Hi everyone, and welcome back to the channel. When it comes to investment planning, deciding how to allocate your assets might be the single most important decision you'll make. But with so many choices, selecting the right investments can feel overwhelming. And how do you combine them into a well-diversified portfolio that balances growth, risk, and any preferences you may have, such as sustainability? In this investment series consisting of 4 videos, that's what we're going to try and answer. Taking an approach that's backed by some of the world's leading financial academics, we'll walk you through what you need to know to build a portfolio for your individual needs and objectives. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. In this first video in our investment allocation series, we're going to review the role of markets, the types of assets you can invest into, and which asset classes you should select as an individual investor. For literally thousands of years, markets have been a place where individuals have gathered to buy, sell, and exchange goods and services. Over the years, markets have evolved from simply bartering in a town square into advanced electronic trading platforms. This evolution has increased the speed and availability of information to investors, as well as fostering competition and innovation between sellers. If you look around the world, free and fair markets are central to our economic systems. They facilitate the flow of information, providing incentives for production and supply, and promoting the efficient allocation of resources. The total value of the world's investment markets has been estimated at around $680 trillion US. It includes real estate, bonds, government securities, listed public companies, gold, private companies, crypto assets, as well as art and other collectibles. It basically includes all the different investments you could put your money into. In this video, we're going to step through each of these markets and determine which ones it makes sense to put our money into from the perspective of an individual investor. The first market we look at is perhaps the most well known, and it's the world's public equity markets. This is where companies list their shares for sale via a recognised stock exchange. The stock exchange provides an important role by connecting companies that need capital with investors seeking returns. To foster participation from buyers and sellers, stock exchanges promote equal treatment for all investors and transparency. To list on an exchange, companies must meet the listing rules, such as publicising financial accounts and adhering to certain corporate governance standards. One key function of stock exchanges is publicising the price of each company so investors can assess its value. A downside of this, though, is that prices can change quickly and will react as new information becomes available. But price discovery provides transparency and helps investors make informed decisions. Today, according to MSCI, an index provider, there are around 23 developed markets, 24 emerging markets, plus another 28 frontier markets, and somewhere around 50,000 listed companies worldwide. These companies span industries across the global economy, from technology, healthcare to manufacturing and real estate. As at the end of 2024, the value of the world's stock markets was estimated at being more than $123 trillion US, according to MarketWatch. Based upon the holdings in the MSCI All-Country World Index at the end of 2024, the US was the largest market by some distance, accounting for around 65% of the total. Other developed markets like in Europe and Japan made up around 26%, whilst emerging markets including China, India and Taiwan represented around 9%. Closer to home, Australia punches above its weight with companies representing around 2% of the global market, whilst here in New Zealand our stock market is a bit more modest at around 0.1% of the global total. Not every company trades on the stock market. In fact, there's a whole world of other private companies that prefer to stay under the radar or aren't quite ready for public ownership. These private companies operate outside stock exchanges and are owned by individuals or private investors. Think of small startups or even massive global companies like SpaceX that choose to stay private. Estimating the size of the private equity market isn't easy, as it's not as transparent as public markets. But according to McKinsey & Company, they're worth around $13 trillion US in mid-2023, or maybe around 10% the size of public equity markets. Private companies might offer the potential for higher returns, but they do come with certain challenges. There's a limited amount of public information, so investors need to do a lot more of their own research. Prices aren't updated daily like in public markets, and are instead negotiated between buyers and sellers. And buying and selling is not as easy, particularly if you need your money out quickly. For most individual investors, accessing private markets usually means investing indirectly through private equity or venture capital funds. These funds are managed by professionals but typically come with high fees. Historically, a typical fee structure has been 2 and 20, meaning that 2% of investment is charged annually plus 20% of any profits made. That's quite high compared to broad-based index funds where the fees might be 0.1% or lower. Private markets can be an exciting space, but they're also more complex and come with higher risks. You probably knew that real estate was a significant asset class, but did you know that it was the largest asset class in the world, valued at more than 380 trillion US dollars? To give you an idea of the scale, global real estate company Savills estimated that in 2022, 76% of this total came from residential properties, which are homes where people live, 11% from agricultural land like farms, fields and pastures, and 30% from commercial real estate, so things like offices, malls and other business properties. For most of us, buying a shopping mall or commercial building isn't very realistic. The barriers include the size of the funds that are required, due diligence that is needed, and selling quickly is tricky if you need your money out in a hurry. Instead, individual investors can invest into property through real estate investment trusts or REITs. These are companies listed on public stock exchanges that own and manage income-generating properties like office spaces and warehouses, making them an option to diversify your investments without the hassle of owning property directly. When we watch the evening news, we normally hear reports about the equity markets, but never very much about what is happening in the bond markets. Yet, despite being less exciting than equities, the world's bond markets are slightly larger. At the end of 2023, the size of the market was estimated around 140 trillion US dollars by the Financial Times. Bonds will typically offer investors a fixed rate of interest for the term of the bond, with a promise that the amount borrowed will be repaid at the end. Generally, the more creditworthy the bond issuer, the less likely they are to default, and the lower interest rate they will need to offer to investors to entice them to part with their cash. Beyond traditional investments like stocks, bonds and real estate, there's a whole world of alternative investments, including commodities like gold, silver, oil or agricultural products, art and collectibles like rare paintings or vintage cars, and more recently, digital assets like cryptocurrency. Estimating the size of these markets is tricky because reliable data is limited. The total value of all gold in the world has been estimated at being around 17 trillion US dollars, and the value of all cryptocurrencies at around 3.3 trillion US dollars. Art and other collectibles combined were worth an estimated 300 billion or 0.3 trillion US dollars. One of the big challenges with alternatives is determining their value. When we look at traditional investments like stocks, bonds or real estate, we can estimate the value from their future expected cash flows. When doing this, we effectively perform a large net present value calculation, whereby we estimate all the cash flows we expect to receive, discount each of the cash flows back to the present to incorporate the time value of money and the risk of the investment, and then add up all the discounted values to attain our estimate of intrinsic value. Now, we need quite a few inputs and projections to do this exercise, but it does enable investors to cross-compare different assets to determine their relative value. With alternative assets, however, there's often no cash flows, and their future value is driven more by supply and demand factors, which makes their true worth far more uncertain and often speculative. While alternative investments can offer some diversification benefits, they also come with greater risks and uncertainty. So far, we've explored the value and some characteristics of various financial assets. We now want to narrow this down to those asset classes that will be suitable for an individual investor. Unlike large pension schemes or institutions with billions of dollars and teams of in-house analysts, individual investors need a portfolio that fits their goals, risk tolerance and resources. So what asset classes should they include? They should include listed equities, including investments in New Zealand, Australia, the US, and other developed economies, as well as emerging markets. Listed property investments, which are listed on public equity markets. Fixed interest bonds, including government and corporate bonds, as well as cash for liquidity and short-term needs. The good thing about these asset classes is that they're easy to access through recognised stock exchanges and brokers, providing both price transparency and the ability to buy and sell investments quickly. So what about the other asset classes we looked at? Well, for private equity and private real estate, these can be options for large institutions, but but less practical for individual investors due to their high cost, limited liquidity and lack of transparency. There's also commodity and cryptocurrencies which are volatile and have no cash flows to anchor their intrinsic value, so considered more speculative, so we wouldn't normally recommend to be held as part of your core wealth. There are also other investments such as hedge funds and structured products. These are rather complex products with limited transparency and where the risks are not always apparent, which makes them difficult to evaluate without expert knowledge. For most individual investors, sticking to the publicly traded investments like equities, bonds and real estate is the best approach. These assets can represent all the major parts of the global economy and provide a solid foundation for a diversified portfolio, which is easy to buy and sell at short notice and can be implemented at low cost. So let's quickly recap what we've covered in this video. We've talked about the role of financial markets and how they connect investors and companies. We've explored different types of financial assets and their particular characteristics. And then we've narrowed this down and determined which asset classes and investments are suitable for individual investors. In the next video, we're going to take things a step further and consider risk factors and risk premiums and how we can use this understanding to build well-diversified portfolios. If you're interested to learn more about financial and retirement planning issues for international migrants moving to New Zealand, we've created other videos that you can explore on our YouTube channel. You can also visit our website www.pacificwealth.co.nz, and if you have any questions, please feel free to reach out to myself or a member of the team. Thank you for watching and see you in the next video.